What if I told you that people are making $10,000 a month in income are now paying zero in taxes legally? And all it took was buying one property and using a powerful tax strategy most people have never heard of. In this video, I'll break down exactly how it works, why it's 100% legal, and how you can use it. It's called the short-term rental loophole to reduce your taxable income to zero while building long-term wealth. And now I know what you're thinking. Is it real? Is it legit? Absolutely. And this isn't about offshore accounts or sketchy loopholes. In fact, the IRS tax code encourages real estate investors by offering specific tax benefits to certain property owners. Hi, Lisa Home Loans here. I'll help you navigate home loans, real estate, and smart money moves. People who make $10,000 a month, that's $120,000 last year, are now paying nothing in income tax. And it's all because they used this one move with the second home. So here's a basic idea. You're buying a second home, not to live in and not to rent out to one tenant for a full year. Instead, you're using it as a short-term rental, which the IRS looks at differently than a traditional investment property. Let's say this house costs $400,000. You put down just 10% or $40,000. Now here's where it gets interesting. Because this is a short-term rental, you are actively involved in managing the property and spending enough time doing it. The IRS does not classify you as a traditional landlord. That means you're eligible for a special tax benefit called accelerated depreciation. This means you can deduct a large portion of the property's value in the very first year of ownership, instead of spreading it out over decades. This can help you lower or even eliminate your taxable income. So what is a depreciation? In simple terms, the IRS lets you deduct the wear and tear of your investment property over time. For long-term rentals, that's usually over 27 and a half years. But when you do a cost segregation study, you break down the property into its individual components. Things like appliances, flooring, electrical, and more, and you're able to accelerate depreciation on those items. With the short-term rental, you can front-load that depreciation into year one, often up to 30% of the property's value. On a $400,000 property, that's about $120,000 in depreciation you can write off immediately. Going back to the example earlier, say you make $10,000 a month, that's $120,000 per year. If you use this strategy correctly, that $120,000 in depreciation could offset your entire income. Your tax bill, zero. You're still making the same money, but now you're keeping all of it because you're using the tax code to your advantage. This isn't a loophole in a shady sense. It's actually built into the system to reward real estate investors who actively participate in their properties. This strategy works so well because it meets three big goals at once. 1. Tax reduction. You legally reduce your taxable income through accelerated depreciation. 2. Asset acquisition. You now own a property that may appreciate and generate income. 3. Wealth building. You're keeping more of your income and reinvesting it. Instead of giving $30,000 or $40,000 to the IRS, you're investing it into a property that builds your net worth. And remember, this all started with just a 10% down payment. Who this is for? High-income W-2 earners, self-employed professionals, business owners, 1099 contractors, anyone looking to legally reduce their tax burden while acquiring real estate. If you're earning good income and getting hammered by taxes, this strategy is worth looking into. What you need to do. If you want to implement this strategy, here's a basic roadmap. 1. Find a property that qualifies as a short-term rental. Consult with your CPA. 2. Put 10% down. For a $500,000 home, that's $50,000. 3. Materially participate in the property. This is key to unlocking the tax benefits. 4. Hire a professional to complete a cost segregation study. 5. Work with a CPA who understands real estate-specific tax laws and can properly file your depreciation deduction. Now, this isn't a loophole you want DIY. Make sure your team is solid so you're protected and maximizing the benefits. If you're serious about keeping more of what you earn and building long-term wealth through smart real estate plays, this is a strategy worth exploring. Don't just work harder, work smarter, and keep more of your money. Subscribe for more real estate wealth strategies and drop a comment if you want me to break down the cost segregation process in more details. See you in the next video.